Financial advisors tell you to put 5 to 10% of your portfolio in precious metals. That's the standard advice. You've heard it 100 times. But here's what none of them ever explain. At a net worth of $50,000, 10% in silver is $5,000. If silver doubles, you make $5,000 pre-tax. That's not wealth preservation. That's a nice weekend in Vegas. At a net worth of $1 million, 10% is $100,000. Silver doubles, you just made $100,000. That's a different conversation entirely. Same percentage, same asset, completely different outcome. And when you see where the breakpoint actually falls, where metals stop being a speculative lottery ticket and start becoming genuine wealth insurance, you'll understand why the standard advice is designed for a net worth level that most people giving it don't even have. My name is Alex, and I've spent the last decade tracking commodity cycles, central bank policy, and precious metals markets so you don't have to. If you want to make smarter decisions with your money in 2026, make sure to hit that subscribe button and give this video a thumbs up if it gives you clarity you can't find anywhere else. Before we dive in, I want to know, what percentage of your portfolio is in physical metals right now? 0? 5%? 20? Drop your number in the comments because I genuinely want to see where this audience stands. Here's what we're doing today. I'm going to run the actual math, dollar by dollar, net worth tier by net worth tier, to show you the exact threshold where precious metals allocation shifts from speculation to preservation. And there's a psychological reason why almost nobody does this calculation, which I'll get to later, that explains why most people get their metals allocation exactly backwards. The conventional wisdom goes something like this. Diversify your portfolio. Put 5 to 10% in precious metals as a hedge against inflation and systemic risk. Rebalance annually. Sounds reasonable, right? Except that's not how it actually works in practice. Because that advice treats a person with $50,000 in total net worth the same as a person with $2 million. It applies the same percentage to wildly different financial realities. And that's where the math falls apart. Think of it this way. Precious metals allocation at different net worth levels is like buying insurance on different houses. If you own a $50,000 mobile home and you spend 10% of its value on an insurance policy every year, that $5,000 might be better spent reinforcing the foundation. But if you own a $2 million estate, spending 10% on comprehensive coverage isn't just smart, it's negligent not to. Same percentage. Different math, different purpose entirely. The person in the mobile home needs to build equity. The person in the estate needs to protect it. And right now, in early 2026, the metals market is creating a scenario where this distinction matters more than it has in decades. Silver went from roughly $71.67 to $21 between late 2025 and January 2026. That's a 69% gain in a matter of weeks. But what that gain means to you depends entirely on a number most financial advisors never ask about: your total net worth. And the reason they don't ask is something I'll get to in a minute, but you need to understand the math first. What I'm about to show you next is the part that changes how you think about metals allocation permanently. Everything before this was just context. Now we do the real work. Let's start at the bottom and work our way up, tier by tier. Number 1. Net worth of $50,000. At 10% allocation, you have $5,000 in precious metals. Let's say you went all silver at $71.67. Silver runs to $121. You just made roughly $3,450 before taxes. After capital gains, you're looking at maybe $2,800. Now, I don't want to minimize $2,800. That's real money. But here's the thing. At a $50,000 net worth, you are one medical emergency, one job loss, one car transmission away from financial crisis. That $5,000 in silver isn't preserving your wealth. It's a speculative bet that you're hoping turns into something meaningful. And the common mistake at this tier is treating metals like a savings account with upside. It's not. At this level, that $5,000 might serve you better as an emergency fund sitting in a high-yield savings account where you can access it in 24 hours without finding a dealer, negotiating premiums, and waiting for settlement. But there's a scenario where even at this net worth, metals make sense. I'll show you that exception in a moment. Number 2. Net worth of $100,000. Now you've got $10,000 in metals. Same silver run, $71.67 to $21. Your gain is roughly $6,900. After taxes, call it $5,500. Better. But does $5,500 change your financial trajectory? Honestly, not really. It's a nice bonus. It might cover a month or two of mortgage payments. However, it's not the kind of return that reshapes your life. The problem at this tier is opportunity cost. That $10,000 in silver could instead be invested in an index fund averaging 8 to 10% annually with compound interest. Over 10 years, that's the difference between $10,000 and roughly $25,000. Metals don't compound, they don't pay dividends. They sit in a safe or a vault and wait. So at $100,000 net worth, you need to ask yourself a brutally honest question. Am I buying metals because the math makes sense, or because it feels like I'm doing something smart? Number 3. And this is where the math starts to shift. Net worth of $500,000. 10% allocation means $50,000 in precious metals. Silver goes from $71.67 to $121. Your gain is approximately $34,000. After taxes, you're keeping somewhere around $27,000 to $28,000. Now we're talking. That's a meaningful sum. That could fund a year of retirement contributions. That could be a down payment boost on an investment property. That could eliminate a chunk of remaining debt. At $500,000 net worth, $50,000 in metals starts to function the way the textbooks describe. It's a hedge. It's insurance. If the dollar devalues 20% over the next 5 years, your metals position preserves purchasing power on a scale that actually impacts your lifestyle. If you've made it this far, you're already thinking about this differently than 90% of people. But don't stop now, because the next tier is where the entire philosophy flips. Number 4. Net worth of $1 million. 10% allocation equals $100,000 in metals. Silver's run from $71.67 to $21 produces a gain of roughly $69,000. But here's what most people miss at this level. The gain isn't the point anymore. At $1 million, you've shifted from building wealth to preserving it. You're no longer trying to turn 100,000 into 200,000. You're trying to make sure your 1 million doesn't become 600,000 because the Federal Reserve printed 40% of all dollars in existence in a 2-year span, which, according to the St. Louis Federal Reserve's own data, is exactly what happened between 2020 and 2022. At this tier, metals aren't a bet, they're a firewall. And the common mistake at the millionaire level is actually under allocation. Sticking with 5% because that's what the advisor said a decade ago when the fiscal environment was completely different. Now here's where it gets interesting. And this is the part most financial content creators won't say because it contradicts the standard playbook. Your metals allocation should increase with your net worth, not decrease. Think about that. Conventional wisdom says as you get wealthier, you should take less risk. And most people interpret that to mean fewer alternative assets, less gold, less silver, more bonds, more blue chips. That's exactly backwards. Because at higher net worth levels, your biggest risk isn't missing out on a 10% stock market rally. Your biggest risk is systemic. Currency devaluation, sovereign debt crises, banking system failures, the things that metals were literally invented to protect against 5,000 years ago. Let me give you some historical context that makes this crystal clear. In 1980, silver ran from roughly $1.50 to $50. That's a 33 times return. If you had $5,000 in silver at $1.50 and it hit $50, you turned $5,000 into $165,000. In 1980, that was life-changing money. You could buy a house with that. That's the kind of asymmetric upside that actually transforms a small account. Now compare that to the 2020 to 2026 cycle. Silver went from about $12 in March of 2020 to $21 in January of 2026. That's a 10 times return. Incredible by any normal standard. But 10 times on 5,000 is $50,000. In 2026, that's not life-changing. That's maybe a year of expenses in a mid-tier city. Meanwhile, 10 times on 100,000 is $1 million. And that is life-changing no matter what year it is. Here's a hard truth that might sting a little. If your net worth is below $250,000 and you're putting 10% into metals, you're not hedging, you're speculating. You're betting on a 3 to 5 times return to make the position meaningful. And speculation isn't inherently bad, but you need to call it what it is. Don't tell yourself you're preserving wealth when you're actually making a concentrated bet on commodity prices. The psychology behind this matters. According to behavioral economist Daniel Kahneman, who wrote Thinking, Fast and Slow, people systematically overweight the emotional satisfaction of owning something tangible versus the mathematical reality of its impact on their financial position. Holding a silver bar feels like security. It feels like you've done something. But feeling secure and being secure are two different things, and the gap between them is measured in net worth. Now here's the part where everything I just said needs a critical caveat. The current supply and demand fundamentals in silver are unlike anything we've seen in the modern era. According to the Silver Institute's 2025 report, the cumulative silver deficit has exceeded 800 million ounces since 2021. That means for 4 consecutive years, the world has consumed more silver than it has mined and recycled combined. 800 million ounces of deficit doesn't just disappear, it compounds. And when you add China's recent export controls on critical minerals, which directly affect silver processing and refining, you get a supply squeeze that even the most conservative analysts are calling unprecedented. So yes, below $250,000, metals are mathematically speculative. But the probability distribution of that speculation is skewed heavily to the upside right now, which means even the small accounts have better odds than usual. That doesn't change the math. It changes the expected value of the bet. Let me bring this back to you specifically. I want you to do a calculation. I'm calling your metals impact threshold. Here's how it works. Take your current net worth, multiply it by your metals allocation percentage. That's your metals position. Now triple it. Because a 3 times return in this environment isn't fantasy. Silver has already done 10 times in 6 years. Gold has doubled. So triple your position. Look at that number. Does it change your life? Does it pay off your mortgage? Does it fund 5 years of retirement? Does it allow you to quit a job you despise? If the answer is no, then your metals allocation is a hobby, not a strategy. And there's nothing inherently flawed about that, but you should know the difference. The real magic happens in your brain. Because metals allocation isn't really about metals, it's about your relationship with risk, security, and control. The person with a $50,000 net worth who puts 10% in silver is often doing it because they feel powerless against a financial system they don't trust. And that instinct is correct. The system isn't built for them. But the solution isn't to buy $5,000 worth of silver and hope it 10 times. The solution is to focus ferociously on increasing income, eliminating debt, and getting to the net worth level where metals allocation actually functions as intended. Meanwhile, the person with $1 million who only puts 5% in metals is often doing it because their financial advisor follows a model portfolio from 2015 that doesn't account for post-pandemic monetary policy, cumulative deficits in critical metals, or the geopolitical fracturing of global supply chains. They're under-allocated because their advisor's spreadsheet hasn't been updated. Rick Rule, who's been in the resource investment space for over 40 years, puts it this way. He says most investors own precious metals for the right reasons, but in the wrong amounts. The small investor owns too much relative to their ability to endure volatility. The wealthy investor owns too little relative to their need for systemic protection. That single observation captures the entire thesis of this video. This is the part where most people check out. Don't be most people. Because understanding this distinction is the difference between being reactive and being strategic. If you're below $250,000, your priority is income growth and wealth building. Metals should be a small speculative position, maybe 5%, funded with money you genuinely won't need for 5 to 10 years. Think of it as buying a lottery ticket with unusually good odds. If you're between $250,000 and $500,000, you're in the transition zone. Metals start to serve a dual purpose, part speculation, part preservation. 7 to 10% makes mathematical sense. If you're above 500,000, preservation becomes paramount. 10 to 15% in physical metals, not paper ETFs, not mining stocks, actual metal you can hold, becomes a genuine insurance policy against dollar devaluation and systemic risk. And if you're above 1 million, 15 to 20% isn't aggressive. In this fiscal environment, with $36 trillion in national debt and no credible plan to reduce it, 15 to 20% in hard assets is prudent. That's not my opinion. That's the math. Now let me tie all of this together, because when you see how these pieces connect, it changes how you approach every financial decision. Remember the standard advice we started with? 5 to 10% in precious metals for everyone? That advice treats allocation as a percentage problem, but it's actually a purpose problem. The percentage stays roughly the same. The purpose changes completely depending on where you sit on the net worth spectrum. At $50,000, 5% in metals is a speculative position with asymmetric upside potential, especially in the current deficit environment. At $500,000, 10% in metals is a genuine hedge that produces meaningful dollar gains during commodity cycles. At $1 million, 15 to 20% in metals is a wealth preservation strategy that protects against the exact scenarios central banks are creating right now. Same asset class, same fundamental thesis. Completely different function at each tier. And the advisors who give you a flat percentage without asking about your net worth, your income trajectory, your debt load, and your actual financial goals. They're not giving you advice, they're giving you a template. And templates don't build wealth, strategy does. You're no longer the person who hears 5 to 10% and nods along without thinking. You now know your number. You know your tier. You know whether your metals position is a bet, a hedge, or a firewall, and you know exactly what has to change in your financial life to move from one category to the next. Your future self, the one who weathers the next monetary crisis without panic, the one who watches the dollar lose purchasing power without losing sleep, that version of you is built on the decisions you make right now with this information. Metals allocation, net worth thresholds, dollar devaluation, the silver deficit. What's the topic you want me to go deeper on next? Drop it in the comments, because that's exactly what this channel is built for. I'll see you in the next one.